Welcome guys to a new video. This one will be a bit more special. It will be about trading, but not in the style I've always been doing. As you can see by the title, today I just want to discuss the biggest problem with ICT traders. First of all, let's talk about defining the liquidity in the market. So according to a few videos I watched from TJR and other ICT gurus, the liquidity apparently, according to their logic, sits below previous session highs and lows. And as a quick example, this is what people usually do. So they mark New York session open. They mark the start of Asian session, which is 11 previous day for me. And now they look for previous session lows or highs and waiting for the New York session price to go beneath or above them. In this case, we have this low right here. So they usually mark the lows, and there's also a fair value gap. Let's also mark this. And next step is they scale down to a lower time frame. So right here you can see that price went beneath this previous session low. So this is the London session, and it also tapped into this fair value gap. And what they do after is they look for confirmation to buy, in this example, by looking at a closure of an inverse fair value gap. So what this means is that basically price has to close above previous fair value gap. In this case, this would be like this small fair value gap right here. And once it does, people would start buying here, but look where price went already. And even though in this case it is a perfect example, because price still went up and you could still make some profits off of this move, you cannot really see what is actually behind the market. Because assuming the move by a single candle, and this is a big mistake, because in single candle you cannot actually tell who is more present in the market. And this is only the first issue. The second issue I see is the way they define where liquidity lies. And as I said before, their concept of the liquidity in the market are previous highs and lows, as I drawn right here. But this is not true. If we look at this Bitcoin price chart on the liquidity heat map from Bookmap, let's just cut this so you can see where the real liquidity is. So what we see on the right is current order book, or basically the book of orders. And what this represents is how big the order or the contract is at each price level. And by those orders, I mean limit orders made by market makers. You can also call this passive order if you want to. But passive orders or limit orders are the actual liquidity, because the definition of liquidity is how quickly can an asset be exchanged into a cash without causing a big swings in the market. So this means that if price reaches this high liquid zone, let's say this one, where there is 42 contracts ready to be sold, when aggressive market participants reach this level, their primary goal is to exchange an asset without causing a big market slippage or big swings in price. This is usually done by big market players like banks or hedge funds for hedging purposes to protect their positions. And the banks like the slow market, where they can exchange and convert assets without causing a big price moves, because if they cause a big moves in price while exchanging an asset, it could hurt their portfolio. And if we look back to the definition of the liquidity in ICT space, they assume that liquidity lies below lows and that it should cause a big market reversal, which is completely false. Because in order to have or cause a big market move, you need to have a least filled order book. And let me conceptualize this. What this basically means is that, for example, if we have this big order right here, which is, let me see how big, 42 contracts or 42 bitcoins. Imagine this like a wall in the price. If aggressive market buyers wanted to accelerate the price of the market, they would first have to transact with this order. And this would kind of slow them down, if not exhaust them or absorb them. Which means that buyers would run out of buying momentum and the price would just stall. Which means that this could be a potential price discovery, forming a new balance in the market. But where market moves the most is in these areas where there is a lack of liquidity. So you can see those orders, they're not even in the size of one, they are just decimals. And this is actually where market moves the most, where there is imbalance. So no, if there was actual cluster of passive liquidity in the market, this price would likely stay at this point for some time. Now let's get onto the third issue, which is, in my opinion, the most stupid one, is when you introduce the volume profile to a retail trader, which again, I do not have nothing against them. If you're just getting started with the markets, it's kind of expected that you won't understand all the stuff. But please don't be delusional when somebody is trying to explain you something. So I saw some traders plot a volume profile on their chart and see all those big complex bar charts, and they saw this line, which is point of control in this case, and they thought that this was some sort of special key level that would reflect and impact the price action. And they also use this as a potential liquidity level, which is in ICT terms a space where price would mostly reverse, which is totally false. First of all, liquidity sits everywhere in the market. Okay, it is not just in the specific lows or highs, it is everywhere. Without liquidity, there would be no market. And what this volume profile shows is aggressive interactions with the passive liquidity. And where there is point of control, it only marks a point where price has spent most time, or in this case with the volume profile, where the most volume has been exchanged prior to what period of the market you marked with volume profile, which is complete opposite of how some traders use it. Because some people think that when price reaches the point of control, it should reverse up, such as this case. And the truth behind the point of control is completely opposite of what they think. Because point of control is completely opposite of that price should reverse off of it. It is a point towards which the price wants to go, because market apparently found balance exactly at this price the most of the time. And then some people also like to plot a volume profile and use it as a liquidity below old lows and highs, which doesn't make any sense, because there cannot be point of control under old high and low if there was previously no market at this price. And one more thing. And all those specific price levels that are marked by volume profile, like the value area low, value area high, and point of control, are not some magic key levels that will help you boost your trading edge. They are just the representation of where 70% of all the volume in the volume profile basically sits, where it is distributed. And that's why the special areas in the volume profile should not be considered as points, but rather a range in price. Because, for example, there is the low volume node, which means that this was market imbalance. This was where the least volume was traded. And this is actually the point where market would most likely reverse out of all those high volume nodes. Which in this case it did when market came down here and there's a low volume. And apparently market did not find any balance or any validation, which means that people did not agree on this price and it just started discovering a new balance, and it found one right here, which was apparently perfect price for people wanting to make a market here. And even with that alone, you still cannot use this with a single candlesticks and just say that there is an inverse fair value gap and this is why I'm going to buy. You need to use those volume tools with the context, and in that case I like to use order flow. And in that case, let's go check out what happened at this day. So this was 11th June 1920. So this is right here. And now if I just adjust those bubbles a bit. Okay, so there was no big player here in the market. But we can see a lot of buyers stepping in right before this move, which means that buyers were getting exhausted right here. Sorry, not buyers, the sellers. You can see the selling imbalance of minus 24%, which means that there was 24% more sellers than there was buyers, which is in that case minus 4080. And now you need to look this in a perspective as reward, as an effort versus reward. So you can see sellers gave a lot of volume in the market, they gave a lot of effort, but failed to move the price down. And after that, buyers stopped stepping into the market. But you can still see some negative volume delta on this candle, which probably means that sellers started getting exhausted right here, right? So they were running out of the pressure and momentum. And this is when buyers started stepping in and started hitting the bid. Sorry, the ask, which are basically the sell limit orders or the sell passive liquidity. And it is because there was either a big lack of sell limit orders and buyers were not being blocked so much by big sellers, or there was just a big spike of buyers that started hitting the ask. And this is how you use the actual liquidity and the volume combined with order flow. So you need to use this as a context. So basically low volume plus sellers getting exhausted and aggressive buyers starting to step in. And this is all I had to say for this video, just to open up some minds on how markets actually work, and hopefully this helped you gain some extra knowledge, and I hope you make it in trading. I will see you in the next one.